everyone. Welcome to another episode of Abegwhosendme. Abegwhosendme is a podcast for entrepreneurs and wannabe entrepreneurs. And it's such a delight to be your host today. My name is Titilayo, Ekundayo, a serial entrepreneur myself. And I'm so glad and excited to have Collins with me on the podcast today. Collins is the CEO and co-founder of Simpu. He has spent the last 7 years developing consumer and enterprise applications for clients like Shell, Sterling Bank, the big boys. He has also been featured by leading newspapers in Nigeria. Prior to becoming an entrepreneur, Collins studied English and literature at the prestigious Obafemi Awolowo University. He enjoys reading, thinking in systems, and taking long walks. Hi, Collins. Good to have you on the podcast today.
Hi.
Hi. Good morning.
Nice to be here.
Yeah, nice to be here. It is our assumption that we have different people listening to this podcast. So entrepreneurs, wannabe entrepreneurs. Some people are not. So as an entrepreneur myself and somebody that is close to the tech industry, I understand words like high growth and all of that. But some people might not be familiar with it. So that was why I was calling your attention to say, now we are looking at it from tech to say, this is how you position your business. It has to be high growth. And then the question is, what does high growth mean?
Okay.
So yeah, that was the question I wanted to ask. What does high growth mean?
Okay. So high growth would be businesses that would typically want to do, in terms of revenue sizes, close to starting from like $1 million upwards, and you want to do it like really quickly. Do you understand?
So do we have examples of those kind of businesses?
Typically, like most of your tech startups, companies that you already know, Flutterwave. I think like I could use Flutterwave or Paystack as an example.
Okay.
They want to grow from like $1 million to processing, say, billions of dollars. Those are the kind of high growth companies that investors typically in the tech space like to back. Businesses that can go from zero to billions of dollars. So those are like high growth startups. You may have like a business where you're not hitting $1 million, you're not hitting $100,000 in revenue per year, but you are doing fine. Like $100,000 in revenue per year is about 56 million naira. So 56 million naira is about 4.6 million a month if you do a quick division, right? So some people's businesses do like 4 million naira a year, some even lower, some do higher, but if you in terms of like summing it up into like high growth, it's not really high growth, it's like a normal business, so those are the risks, those are the yardsticks for judging. So if you're in that kind of sector where yearly you're hitting $100,000 or lower, you may want to be careful about like taking in investments, because investors, it's not free money. Even though they are buying shares in your company or buying equity in your company, it's essentially not free money. So reality is that it's essentially not free money. So the reality is that there's a lot of pressure that comes with the money. So when an investor puts in, say, $100,000 in your business, they typically want to hear like every month, they want to hear that you are growing fast, and some entrepreneurs may not have the mental strength or the emotional balance to be able to deal with something. Money is never enough, right? So you may do $1 million, but your investors are like, and there are a good number of businesses that have been built that have literally been built by not taking any investment at all. A good example, I think, is MailChimp. MailChimp was founded by two guys, I think.
So how did they survive? Because MailChimp is like, one of the top guys in the subscription newsletter business. So we're talking about MailChimp.
What did you last hear?
You're talking about the MailChimp guys.
MailChimp, okay, yes.
And how they bootstrapped. They didn't take any investment.
Yeah, they didn't take any investment. But it took 20 years before they got acquired, before there was an exit. So, I mean, if you want to compare that with a high growth startup, Flutterwave right now is valued at over $1 billion, maybe even $2 billion, who knows? And Flutterwave is about 5 years old. Do you understand? So if Flutterwave was going to get acquired right now, they'll be acquired for around what their valuation is, right? So if Flutterwave is doing it in 5 years, MailChimp took 20 years. So that's the difference between high growth startups and if you're just, high growth companies, and if you're actually just going in the normal, slow and steady way. Do you understand?
Collins, I have a question. So from what I think that you said is that what makes it high growth is the money you take in. Because MailChimp didn't take in money, and then they took 20 years to build. And then Flutterwave took in money, and then 5 years they're a unicorn company. So is it on the basis of the money you take in that makes you high growth, or the size of your balance sheet to say, okay, so I have this balance sheet, I want to take in investment? Yes.
No. So I think it's pretty much around the business. So can the business grow really fast? Is it a business that can grow really fast? So if you identify your business as something that can grow really, really fast, and big, right?
Okay, let's put numbers to it. What is fast? What is
capital?
Big? Really fast is really fast from 100 to 1,000, or really fast from 100 to 500,000.
Okay, look at this. It's not a business in question. It's not even a business. It's a pyramid scheme. It's like MMM, for example. It's not a good example, but you'll get a good idea of what I'm talking about. A lot of Nigerians did MMM, lost a lot of money in MMM and co. But you could see that MMM, from when it first started to when it crashed, it wasn't so long. It wasn't like something that was for 10 years that was happening. It was in this space of, I don't know, maybe 20. Every environment, every city, every state, there's someone that was doing MMM and putting in their money, right? Now, that is an example of something that can scale really wide, right? Those are the kind of businesses that if you now had a genuine business and it had those properties of being able to scale very wide, it has a lot of people using it. The word would be ubiquitous. It was something that could spread wide. It could look at agency banking, right?
Yeah.
Companies
the POS guys,
OPay, the POS guys. See, they are able to scale to every nook and cranny of that is a potential. That is a potential of a high. That is a high growth company. So now if you were trying to build a POS company, like an agency banking business, you now need investor capital, because you have to get POSs that go around. But very clearly, if all these POSs go around, it's going to do revenue in the billions or whatever. Do you understand? If your business is like that, then it makes sense to take an investor, because you can't really do it yourself, right? But if your business is I'm selling clothes on WhatsApp, right? Or I'm selling clothes on Instagram, you may not really need to look for investors. You may be better at making sure that your customers pay upfront, and as opposed to you taking investments and all of that. But if you want to now make that your e-commerce business become very big, bigger than a lot of people's own or whatever, you may take investors money, and then investors money can allow you to do things like subsidize the cost. So you can reduce your own prices, so that you can win more customers and all. But the question is, you need to think about the long-term viability of those type of businesses before taking an investment. Because if you take an investment, once you grow the initial customer base or revenue or whatever metrics you're tracking, you're not going to stop, right? You kind of need to keep growing it and growing it and growing it and growing, and you have to be growing really, really fast. Quarterly, your numbers shouldn't look the same. There has to be growth. And so all of those pressures are things that investor capital brings to the table. They give you growth, but they also give you like reasons to move really fast. So you have to kind of like be sure of the type of entrepreneur you are and the type of business that you're in, and like if you take an investor, you kind of have taken a boss as well, even though it's your business, because you have to report quarterly or monthly, depending on how the investor works. You have to say, we've grown our numbers from this to this, that kind of stuff. So you kind of need to be sure before you start to do like positioning. So if you now say you're sure of your business, you're sure of like
Collins,
everything.
I like to reiterate what I hear from time to time, so that I'm sure that what I heard is correct, or what I heard is the intent of what was being said, or whoever said it. Okay, so if I get you clearly, you're saying that there comes a lot of pressure with investor money. So first and foremost, you ask yourself the question if you're ready to deal with that kind of pressure. It's kind of pressure that is like you have a whip, on your back, saying you have to perform month in, month out, and you can't have a better last month.
You kind of need to.
Yes, you can't have a better last month.
Yeah, exactly.
Okay,
you can have two better last months.
You can't have two better last months. It's trouble. And then having investor money is like having a boss. So you have to report and do all of that. So in a sense, so it's your business, but in a sense, you have to be accountable to other people, because of course it's their money that you're using to grow the business. Yeah,
also accountable to your employees.
So you're accountable to upwards and downwards. That's clear. And then you're saying that if you can do without investor money, try and do without investor money. That means what's the name now? That means try and get money from your customers earlier on and all of that.
Yeah, like it depends on your business. Yeah,
depending on Okay. Please go ahead.
Yeah, the reality is that what you're looking for really is capital, right? Mm-hmm. It's actually capital. You're not really looking for investor for investor's sake. You're actually looking for capital, right? So so you may not necessarily streamline your line of thought to somebody giving you capital. There are certain businesses that taking debt really works better than shelling out equity out there. There are sometimes when you can essentially get your customer to pay you upfront for the service and then use the capital to push. So there are just a lot of like approaches to like taking the business with capital.
Okay, thank you for mentioning that actually, because I just wanted to point out that there are some times that you get to a point in your business that you actually do need some sort of inflows to actually even meet up the requests of your customers. Now, you've mentioned debt, you've mentioned equity, you mentioned having the customers to pay ahead of time. So what situation would going the debt route be the best option? And then in what situation would going the equity route be the best option? Okay, now I would like, Collins, I would like you to put in context knowing that, so yes, tech, big, but there are a lot of businesses that are just, I just want to create HR solutions for maybe Nigerian businesses or African businesses. It's big, but tech is always like the whole world. It's always global. So maybe my own business is I just want to sort out Nigeria and Africa. So how do I know which option is best? How do I, decipher? Debt route?
I would sort of just use like the example that you have like a HR tool that you're building for like a Nigerian business, or for maybe even a HR tool for medical hospitals.
Okay.
So that you have like a very niche, small segment, right?
Exactly.
So here's the angle that I'll think about it. Like if you're building a HR company, and this HR company is a mix of technology and let's say even consulting, in the sense that there's actually a human being that talks to somebody in that company, or helps you look at your books, or helps you run this thing. How much would this technology cost in a year? If I have to have additional consultants who are part of my company, how much would this cost a year? You're going to have to also break it down and say, how much am I going to put like if it's software that we are using, I can pay a yearly fee for this software. Let's say I pay $8,000, let's say $500K for this software that we're going to use to do this HR thing for these hospitals, right? And I now want to have additional consultants that they can speak to on the phone, or they can talk to on Zoom or something to address issues. Maybe you say for the hospital paying for a monthly subscription, you speak to a consultant and they use a software or something.
Okay.
Right. That's the scenario, right? So you need to know whether how many consultants do you want to keep on your payroll? Do you want to keep those consultants on a monthly basis, or do you want to pay them on a quarterly basis, or you want to pay them on an annual basis? You have to do like some small basic accounting, small thinking around this. Once you do that and you generate substantially the cost, if I get 12 hospitals or 20 hospitals that pay me an annual subscription of $1,000 per hospital, and 20 companies will be $20,000, right? And so you can the goal will be that when you're selling to the companies, to the hospitals rather, you're not selling that pay me monthly. You could actually say pay me for a year, right? And you're essentially just taking the bulk of the money, and you already have monies to pay to run like payroll, to pay for the software, and you have profits. So it's kind of like thinking about it that way. In terms of debt, right? You can say, okay, I don't want to give anybody equity in my business. But what I can do is that I can take debt for $20,000, and when I'm going to return this debt of $20,000, it's going to be $25,000 or $22,000, right? And this can give you the opportunity to actually your business. But the way you're looking at it is also that if you get this debt and you're making $40,000 from this whole thing, and everything on the debt is like $25,000, you kind of have $15,000 as yours, right? So it's kind of like thinking about it in those forms. The difference with equity is that you are selling something that at the moment when you're selling it is non-substantial, like shares. Like I've sold shares in my company right now. The reality is that to the investor, it feels like they just signed something on paper, right? It doesn't feel like there's a lot of weight on it at first, because it feels like free money. Okay. Yeah, it feels like free money at first, but the reality is that it's not free money, because the minute the business starts to make sense, then it becomes really big, and then the investor now can exert like a lot of authority on the business. But at first, when they are giving you that money, it always feels like someone just gave me $20,000 now. Like it's like free money. It's like they dashed you. They didn't dash you. They literally bought shares in your company. And if you are not smart enough, you could even lose the entire company because of you are just raising capital, right? So a lot of the companies that you see that you think that they've raised this amount of money and all of that, there is a lot of, you need to kind of dig deep to know exactly how much of the company that founder owns. Some of the big companies that you see, some founders don't own more than 4% in that business, even though they are the founders. Investors own the rest, shareholders own the rest. Do you understand? But so you just need to sort of think about like how the business works. So most of the time, it makes sense to pretty much bootstrap a bit at first, and that's sort of like what we did at Simpu. Sort of bootstrapped a bit before we took outside funding. At least in that part of bootstrapping, we're able to at least test the water, see whether our company can grow or customers can pay us a lot of money and all of that. And then that buys you some time and you don't get that pressure. At least you can fail on your own. If it's
your own money,
you can still fail on your own money and your own terms, right? And taking money from people, there's a lot of reputational things involved. You can't just take money from people, disappear, or not report. That's why I said you kind of need to have like you're essentially accountable. You have like a small boss, and the higher you go with the money, or the more money that the investor brings, the more power that they have to the more authority rather that they have
to exercise,
to want maybe sometimes to exercise, to maybe even influence like your decisions or something.
Okay. So Collins, I want to ask that. Okay, I get the scenario when you're talking about the dollars and the dollars and dollars of like some people said you'll be swimming with the dollars. So the tech guys are is it okay? Maybe because it's a global thing that you're just comfortable with putting everything down to the dollar value. It's because it's a global, you're building a global business, so you should use a global currency. Is that why?
Actually, because a global business, it's partly because of like inflation and like using the naira. If you plan towards like buying something with let's say $20,000 is about 11 million plus. If you plan on buying something with 11 million or starting your business with 11 million, we can wake up tomorrow and that money just increases to 12 million because like the price of cement is no longer the price of cement. So it's usually nice to just peg it at a stable currency that does not. At least it's stable to an extent. Yeah. So that's why most tech businesses tend to. Or most businesses, tend to peg the stuff at the dollar value. Especially if you are buying a lot of outside of Nigeria type things. Maybe you're importing
and all of that. Yes, it's wise.
Yeah, and e-commerce brands, for example, sometimes you may be buying from China, you may be buying from Alibaba and all of those places. So you need to peg it at what you're buying. The value you're buying is over there.
Very, very correct. So, Collins, I wanted to ask, what should be the markers to say, okay, so you said something very, that I found very powerful and very instructive to say, okay, so bootstrap a bit, learn to fail on your own money, on your own terms, have a feel of the market to see how the market will even respond to your product before you now look for external funding. My question is, how do you know that it is time to look for external funding? The markers, that your business will show, the markers that you yourself as a person will show that you're ready to handle, the pressure that comes with getting an external fund.
There's no rule book to this thing, right? But the reality is also that when you are pressed, the most times when you are pressed, your business will tell you. You would feel I feel like you would feel like an intense amount of pain as an entrepreneur.
Pain where? Your heart, on your head, or
you
on your body?
Like in your heart, in your body. Actually, you feel like a lot of pain. I think pain is a very good marker to be sure that you need help, right? So, for example, let's say you're bootstrapping and it's just you, right? Yeah. It's just you that you're doing it, and you're doing like a lot of work. Like the work is so much and it's really painful. And you know that I need to hire some extra hand to help me do this. That's like a sign that imagine if you were packing. Okay, let me use an average baker. Imagine if you're a baker, right? And you first start with like one order a day or maybe one order a week. That's something that easy peasy. You can just quickly whip up the dough, put it in the oven, and then your cake is ready and you can call the delivery guy and deliver, right? That's easy. When you start to get like 3, 4, 5, 6 orders a day, two things. It validates two things. It shows that you have skill, and it shows that people like what you are doing and they want what you are doing, right? So you're obviously getting some things right, correct? But then it's now beginning to take a lot of toll on you physically. There's a lot of pain. You may not have hours anymore. You feel like your body is hurting. That is pain, and that's a sign that shows you that, hey, I need to hire one more person to help me, right? Okay. Correct. Yeah, and that is the sign, the clearest sign. So now, imagine if you hire that one person and two of you are also feeling a lot of pain because the orders are a lot. You kind of need to know that you need more people, more processes, and all of that. Now, you then ask yourself, does the business have the amount to be able to provide those resources, right? And if your answer is no, that's a good sign to say, okay, I need extra money to do this. And then the reality is also that in this whole period, your business has built some data. You've built some data about your business. You can now say confidently to an investor that we do like 7 cakes a day, and it takes us 20 hours to do. If we get extra funding, we can hire X amount number of people, and we can cut that into 2 hours, and we can even take more orders. Do you understand the progress? At least you now have like talking points to say, hey, this is why I need the money. So if you're doing like, say, a tech company, for example, you may be writing the code yourself, but you just realize that you're not moving fast. You have like customers saying, I need this feature, I need that feature, and you realize that no, I have to hire more people to write these features faster. And especially when the customer is paying, then you know that you're feeling like a lot of pain. Pain is the ultimate marker for me. Pain is the ultimate marker. And then there's also like, there are some times that there is something called like a fad. When this shirt, my money grows like grass or something like that. I think there was this time that there was this shirt everywhere. My money grows like weed or something like that. Can you remember?
Yeah.
There was this popular shirt. Yeah. That's a fad, right? So there are certain times too that there's also a fad where you may be in a sector, right, that people have been talking about a lot, right? Maybe people have been talking about a lot. So a good example would be like the guys that are in all this crypto space now. There's been a lot of talk about crypto. So there are a lot of people that have some money, or investors that are hanging around those places, and like they are looking for like the businesses that are trying to do something in that space. So there are sometimes you may need to identify that there is an opportunity because of the trends that are happening, right? The money may come easier than normal, especially when people are like interested in something. Like if people are interested in e-commerce now, buying and selling stuff, you may see more people. It's just like if the trend is popular, it's easier to, you can, the way you can think about it is, if the trend is popular, right?
Yeah.
Can you? Yeah.
Yes, I can hear you.
Try to ask your friend for money about that thing, or try to ask your mom for money about that. If your mom doesn't really throw a lot of like, I don't know what this means, if she kind of understands it, tendency is that, some people have money that they want to put into that thing, and you may find the money easier. Do you understand? As opposed to like if it was a completely unknown something and you're just like hunting for funds. So pain, and they're just being able to spot like trends, and also just like your personal ambition. To be honest, if you think that this thing can be bigger than what it is right now, because you are convinced in your heart, everything is also heart, and just your heart and your gut feeling. If you are very sure that you're sincere with yourself, that you really think that money will make this happen faster, why not? If not, why not? Just know the pros and know the cons, and then take a stab at it. So there's no rule book, but I have used pain a lot and I know a few of my founder friends also pain is like the most visible marker that
shows you that you need to make adjustments.
We need to hire, we need to raise more money to be able to continue.
Okay. Thank you very much, Collins. We've actually learned a lot from this conversation. On the final note, what would you like to say to people as regarding getting investments, going the debt route, or either the debt route or the investment route, or even the equity route, or just bootstrapping till they get results? What will be your final advice to them on this podcast?
Okay, so what I would say is sort of like determine like the industry. Let the industry determine like whether you go for venture or not. If you think you're in an industry where you can really cover a lot of ground and you can grow really big by being aggressive with the market or whatever, I think that it may be smart to sort of get venture money in if you can find it. But if you're in a small niche type market and based on like what your personal ambitions are, if you really just want to grow something at your own pace, and you want to take care of your family, take care of yourself, you're not looking to be the next Zuckerberg or something, I think that you may be better off sort of just bootstrapping the business and maybe trying a bit of debt financing, where you manage the whole expectations a bit. But so it depends on like your personal preference. If you don't like the idea of reporting to somebody in the morning and at the end of the month or at the end of the quarter and saying this is how we grew this, or you don't like the pressure, I think it's best to just stick to like the bootstrappers approach. Do it at your own pace. If you're convinced you can also still be big and you're patient enough, I mean, it may almost always be like the best, sometimes the better approach in this climb. But then don't be naive. If you see the opportunities to raise capital, because there are certain trends and there's cheap money in the market, by all means raise the money, but just be careful about how much equity you're giving in your company. If you're sure that the company would be really valuable in the near future, you need to be sure that you still own like a substantial amount of the business, even if so that somebody does not kick you out of your company. It happens. Steve Jobs was fired from Apple from a company he started. Like that's a good example of what can happen. But then you can also be like Zuckerberg of Facebook, where you own a very strong amount of your business, or you have authority in your business. So it's either ways. It panders to both sides. So it depends on like on the entrepreneur himself or herself.
Thank you very much, Collins. It's been a delight having you on the podcast today. I'm sure that everybody listening and everybody that would listen would find one or two things that would be very impactful to them. Thank you very much, Collins.